So welcome back to the Millionaire Incorporated Forex Basics Trading Course, Module 2 on Charting, Part 2, Technical versus Fundamental Analysis and Trends. So what we're going to cover in this part will be the difference between technical and fundamental analysis, types of trends and how to identify them, and market structure. So analysis is what we do to determine which way the price of a pair will move over time. We want to try and use what information we have at our disposal to come up with the most accurate way of predicting future price movements of the pair. And there are two ways that you can actually analyze the price of a currency pair and markets, and they are fundamental analysis and technical analysis. And there is usually a massive debate about which controls the market or which is better or what one drives the other. So fundamental analysis works off the economical reports and data from central banks and governing bodies of countries. So in Australia, you have the Australian Bureau of Statistics, in the US, you have the Fed, etc. And they release reports regularly on unemployment data, jobs growth, wage growth, consumer sentiment, etc. And each of these have an impact on the economy and traders' outlook on the currency pairs they are trading. And this is also what some traders actually base their numbers off. So working off fundamental analysis needs pretty complex pricing models, a prediction of what the data will be over time, access to the news and the data the split second actually comes out, and being able to react on the price of that currency pair as soon as that price comes out, which is very difficult as a household trader, as you're trading against big banks and institutions, and they typically have very fast internet speeds, lightning quick access to all the data, training in the analyzing of the data as well. So major government decisions such as elections and disputes between countries can also have a major impact on price of pairs too. And some of these events can have a massive impact on pricing which you predict, and when these occur, I suggest steering clear of the market. So an example of this was the Brexit decision and the impact it had on the British pound, and also the trade wars between the US and China, and the impact that has on the US dollar and other pairs as well, which are impacted by Chinese trade. And institutions see these announcements as to what the impact has on the US dollar. So while fundamental analysis may not be the technique of analysis that you use to predict the price action of pairs, it's still very important to know that when these major news events are about to occur and where to find the news, because these major news events do move the markets very rapidly and very wildly. So it's very important to know where to actually find the news. So this is so that you don't actually get blindsided by the spikes in volatility of the pair, which can cause you to have a substantial loss. You can use myfxbook.com to find out when news events are occurring, or investor.com and other similar websites. And you can see what events are coming up for the countries that you're interested in, and the news events can also be broken down into the low impact, moderate impact, and high impact news events. So the high impact news events are typically interest rate decisions and unemployment data, and the biggest news events occur in the US and are typically the US non-farm payrolls, or the NFP, and this typically happens the first Friday of every month, but always check with myfxbook.com for the times and dates. And if you're new to trading, I strongly suggest that you try not to trade the NFP announcement, and even steer clear of US dollar pairs around the time of when it does come out, because it can move pretty quickly and you can be whipsawed pretty quickly as well. Now, I'm not the best at fundamental analysis, and I spend the majority of my time, if not all of my time, using technical analysis to analyze the charts. So technical analysis assumes that the numbers from the reports have already been priced into the market by these major institutions, and that price action over time is a result of that. So with technical analysis, you are analyzing price action to determine what will happen to the price of a currency pair moving forward. So you're typically looking for trends, areas of support or resistance, types of moves the currency makes from these areas, and trying to trade with it. And always remember, in trading, the trend is your friend. And it's a lot easier to trade with the trend than against the trend. So always try to follow the trend and make trades based on that. So what makes a trend? So there are three kinds of trends: uptrend, downtrend, and a ranging trend. An up or a downtrend is pretty self-explanatory. An uptrend is looking at the price over a defined period of time, and if the right side of the chart is higher than the left, the price has moved up over time, so it's trending upwards. And vice versa for a downtrend. If the price of the pair is lower on the right of the chart compared to the left, it's in a downtrend. And a ranging market is just a ranging market trend is just means that the price of the pair is just ranging between two limits, an upper and a lower limit, and just moving pretty much sideways. So pretty much simple stuff. So let's look at how this looks on a chart, and I've created a couple of images to highlight this for you, so it might be a bit easier to understand. So the first one here is an uptrend, and as you can see, the right hand side of the screen is higher than the left hand side, and it's typically moving in an upwards fashion. The next image is a downtrend, and as you can see, the right hand side of the chart is actually lower than the left hand side of the chart. You can even see the price, which is actually highlighted here. So it starts from roughly 9100 or 0.90100 and drops down to 89,435. So that's about a 50 pip move in that downward motion. Now I think it's on a small time frame, so on high time frames, if you're looking on a trend, it might actually be a larger move. And the final illustration we have here is a ranging market. So you can pretty much see it's kind of going just sideways between an upper limit and a lower limit, and not really kind of going any higher or making any new exciting changes there. So another way to define an up or a downtrend is to look at the market structure. So market structure means what the price is doing to determine it's in an up or a downtrend. So for an uptrend, what we are looking for is higher highs and higher lows over time. For a downtrend, we are looking for the opposite, so lower highs and lower lows. So the market creates this because the price of a pair doesn't just move up or down in a straight line. It goes through periods of rallies and retracements. So the price might move sharply up, then over a small period of time or long period of time, it might come down a little bit, then we'll rally up higher again sharply, or vice versa if it's in a downtrend. So this pretty much makes like a zigzag pattern on a chart. So a rally is simply where the price is moving in the direction of a trend, and a retracement is a pullback where price is taking a break from its movement and pulling back a little. And this is why it creates these higher highs and lower highs, or lower lows and lower highs, depending on the trend. So this is what it looks like on a chart. So this is an uptrend. So you can see on the left hand side we've highlighted a higher low, then created a higher high, then price kind of came back down again and created a higher low, then moved up higher again, created another higher high, created another higher low, and then rallied up again, creating another higher high. So we can also use this information to determine if the trend is changing over a shorter period of time, because it actually breaks this market structure. So for example, say the Euro USD is in an overall uptrend, so it's creating higher highs and higher lows. Then all of a sudden when it retraces, it drops below the most recent higher low and creates what we call a lower low. It then rallies up and creates a lower high, and this has just changed its trend because now it's entering a downtrend. And this will be confirmed when that creates a new lower low as well. Now this could also just be a start of a retracement on a higher time frame. So say we're normally looking at we've been looking at 1 hour charts and it's been rallying for a couple of days, and this scenario occurs on the 1 hour chart. We can then switch over to a 4 hour or a daily chart and see that it's only just retracing. So it might only just be making a small move downwards before it kind of rallies up again on the daily chart. So this is also where multiple time frame analysis occurs. So you want to be looking at multiple time frames, higher and lower, to determine what the long-term trends are, what the price action is actually occurring, or what the price action is actually doing, and if it's actually coming up to support and resistance or trend lines on those higher time frames. So that's the end of Module 2 Part 2. Stick around for Module 2 Part 3.